This title's a bit of a clickbait because we ask, is Trimble trading at a discount? And usually that will be accompanied by some analysis and a whole bunch of acronyms and ratios when we're talking about something that's a little bit bigger than financial ratios. Today we want to start the conversation by talking about conglomerates. So a conglomerate, according to a definition we found on dictionary.com, is a corporation consisting of a number of subsidiary companies or divisions in a variety of unrelated industries that have usually come together as a result of mergers and acquisitions. Now you can think about where that might not be the case, and what could come to mind would be firms like Intrexon or Ginkgo Bioworks that try to create a whole bunch of subsidiaries in different industries, only that we don't know of a firm that's done that, that's succeeded. And that's why it's usually a whole lot easier to pull a bunch of firms together under a single corporation. And the classic examples of this would be 3M and J&J, Johnson & Johnson. I was just thinking, we wrote a piece, and I'll include it in the description of this video along with our pieces on Trimble. We had written a piece at one point talking about the single best stock you could hold if you could only hold one stock. And you'll see this question asked on Twitter and whatnot, and people always respond with some growth stock. But when you're looking at investing, you have to consider risk. And in the world of technology, things change very quickly. This is only one stock that you can hold. Two good examples. The first comes to mind would be J&J. That's because it's a conglomerate, so you're actually getting a collection of businesses. So if you have to only hold one stock, you want one that's diversified as possible. Same holds true for 3M. Both those firms have not only paid, but increased their dividends for over 60 years. Imagine getting a raise every year for 60 years. That's what happens when you're a shareholder of those companies, and they'll do what they can to preserve those track records. So these happen to be two firms we're holding under our dividend growth strategy. Another one we're holding is also VFC. They're, you might know their brand North Face, perhaps it's a popular one. They also have some jeans brands. I think they have Vans. And they're a collection of clothing businesses, you say clothing and footwear, where they'll sell a company that they're holding or they'll buy one. They recently, I believe, spun off a collection of their lower growth businesses. Would that still be a conglomerate by definition? No, because it's only in a single industry. However, it still enjoys some benefits that conglomerates do. We'll talk about that. So what about Trimble? Well, Trimble by definition is a conglomerate. So you see here on the left, the industries they're dabbling in: geospatial construction, ag, and transportation. And what we liked about this firm when we first took a look at them was that they're dabbling in two areas that have some of the least digitization, according to McKinsey. So they have the most opportunity to improve using technology: construction and agriculture. So we also happen to like the geospatial thesis, though this isn't referring to imaging, this is more referring to location. And they also have transportation, which is appealing in how they're connecting fleets of trucks. So there's a lot to like about this collection of disparate businesses. Usually what we'll find, an example might be Teradyne, is a firm that's dabbling in a bunch of stuff, and they happen to hold something that we really want, like industrial robotics. So to be fair, Teradyne does offer some exposure to 5G. So there's more there than just robotics. But by definition, Trimble would be considered a conglomerate. So when we look at their revenues, we see that just starting by looking at percentage of total, that building and infrastructure would be the biggest, followed by geospatial, then resource and utilities, and transportation. But another important thing to consider is margin. How profitable are these segments for the company? You can see transportation, that's the least profitable, and it's also growing the slowest. So then you can look at 2021 year-over-year growth. And we just pulled this table together, and it's quite interesting. So Trimble as a conglomerate has grown 16% over 2020. That's pretty impressive for a collection of businesses like that, and a margin of 23.4%. We usually talk about gross margin when we analyze tech firms. In this case, we're talking about what they'd say net margin, so the actual profitability, the bottom line, right? So this is a profitable company that's growing. When we look at their growth over the years, you can see revenue growth on the chart there on the left. They had a little bit of a setback around the time of the Rona, as everybody did, but they've been able to resurrect that growth. The chart on the right shows their revenue mix over time, which has software services and recurring as a percentage of total, and then just recurring. Now, we love recurring revenues because they're predictable, so we want to see that percentage grow over time. Now, when considering Trimble's past, they have quite the track record of acquiring companies. So they've been around 43 years. They've bought over 100 companies and sold more than a dozen. Recently, they've been selling at a much quicker pace. So they sold 5 businesses this year so far. You can see on the table there to the right what those businesses were. 4 businesses in 2020 and 3 businesses last year. So they've been sort of consolidating their focus, which is a good thing, and offloading. I think the combination of the businesses that you see here accounted for about $145 million of top line revenue. So there wasn't a lot happening with these companies, and it's part of the firm's focus on what they're calling connect and scale. So they have a new CEO. This gentleman used to be the CFO, I believe, and now he's taking a very pragmatic approach to growing the company by simplifying things down and connecting the different business lines. And he calls this connect and scale. And a key metric for this effort is annual run rate. You can see here the growth of that as a total number over time compared, I believe, to the previous quarter. And that's some good, strong growth. And when you look at that growth across segments, quite interesting. So geospatial hardware is a big component of that. See, if you look from left to right, you can see these are the 4 segments, and that pie chart for each segment, which is labeled on top there, shows the percentage of recurring. Well, transportation has the highest percentage of recurring. Geospatial has the lowest. That's a bit counterintuitive, but because we always think of geospatial as subscription services, I guess. But on the far right here, you can see the metric, the percentage of recurring revenues, and then software and services and hardware. And you may wonder about software not being recurring. Well, we noticed in putting this deck together that they have these everlasting licenses. And when you're a software company with everlasting licenses, that's not so good. You want the license to last per period. So they've broken this down, and they don't provide a whole bunch of granularity more than what you see here in terms of what these segments do. A subscriber had raised that question. Well, what do they actually do for agriculture? Well, they have these metrics that talk about, how many hundreds of millions of acres they cover and whatnot. But be that as it may, the reason we wanted to talk about Trimble being possibly discounted is because there's a belief in the world of economics that says there's a conglomerate discount for stocks that trade that are a collection of divisions or subsidiaries. And the way that you calculate that is that you take the intrinsic value, that's the real value of all the smaller companies. So you can pretend that these divisions or subsidiaries are individual stocks. You add them all together, then you subtract the market capitalization for the entire conglomerate, and you'll have stuff left over. This is the sort of work that MBAs do. And typically, there's somewhere around a 10 to 15% discount in valuing conglomerates. Why? Because the market believes that since they're not focused on a particular industry, that they'll always be mediocre in a number of industries and not perfect in a single industry. That's the theory behind why this conglomerate discount exists. Well, there's also an argument to say that there should be a conglomerate premium, perhaps. And we've always ascribed a mental premium to conglomerates because of that diversification effect. Going back to our example of the single stock that you could hold, if you could only hold one stock, would probably be J&J. And if they weren't around, 3M, because they're a collection of diversified businesses with a track record of being able to navigate some serious economic diversity. If you're only going to hold one stock going forward, you better make sure that they can survive. Tech stocks are appealing, they may not survive. So that reduction in volatility that you get with a conglomerate, that this is a firm called Maricon, I don't know if I'm pronouncing that right, they proposed that there should be more of a premium, and they said that firms that are structured as conglomerates can often deploy more capital and take more risk in a single business than they could if they were a pure play. And that's absolutely right. There's also the potential for synergies. You see Trimble's doing that with their geospatial segment. And they talk about this benefit portfolio management, the potential for management to make both profitable acquisitions and divestments. That's very powerful. That's something that VFC Corporation can still realize, even though all their subsidiaries are still in the same industry. So many of these diversified conglomerates have developed competencies in doing profitable deals. We studied in B school that one of Cisco's core competencies was their ability to acquire and integrate companies better than anyone else. Now, I don't know if you would consider Cisco to be a conglomerate. I'm actually not sure. I haven't looked at what they're doing for a while, but you get the idea that you could argue that there should be a premium for the diversification effect that you get by holding a conglomerate. Conversely, you can say that, well, they may not grow as fast. Well, Trimble is growing at a decent clip. Now, there's this question of Trimble being a space stock or an IoT stock. And here you can see the top 5 holdings for ARK's space ETF. And Trimble has occupied that top slot now for at least a year. And I guess their idea is that the geospatial component or the connectivity is more related to space. We would consider it to be an Internet of Things stock more than we would a space stock. So when we look at how this Internet of Things stock has performed over time, this is quite interesting. So we know that there's a bear market happening, and since the beginning of this year, the NASDAQ has lost 28% and Trimble has lost 33%. Well, you need to back out the benchmark performance when you look at any single stock to see true performance. So subtract that 28% from the 33% that Trimble had lost, means Trimble lost 5% year to date. So you can see that that diversification effect is providing some stability. And even though we don't put a lot of merit in short-term stock price movements, that still demonstrates this concept of beta. And I don't believe Trimble is actually listed as a low beta stock, but it's a similar concept that when a low beta stock trades, it trades less than, let's say, a beta below 1 would trade less than the exchange movement. So it's just a measure of volatility. So the real takeaway here is that when you're measuring the performance of any stock, always consider an appropriate benchmark, as we've looked at here with Trimble. Now, lastly, I wanted to touch on valuation ratio. And Trimble is, you would say, not overvalued. So I've provided a list of companies here. A lot of these are SaaS firms, so strong gross margin SaaS firms that are growing very quickly, and some have quite the premium. And you can see here Trimble would be right towards the bottom with a simple valuation ratio of 4. That's pretty good considering that this coming year, according to their guidance that they've given, and that also takes into account the businesses that they have divested, they expect growth for 2022 to be nearly 21%. That's pretty darn strong for a conglomerate because larger companies typically don't grow so fast. And we also see that their diversified business lines provide some support there when it comes to the share price performance. But typically as well, they'll also mute potential returns going back to that conglomerate discount. So it's all very interesting. We find Trimble to be a quite compelling firm. And if we decide to add shares of Trimble, our premium subscribers will be the first to know. So thanks so much for taking the time to watch this video. Drop your comments in the comment section. I'll put the links to the articles used for this piece in the description of the video. Thanks for your time today.